Hi everyone, this is Professor Smith, and in this video we're going to go into more detail about the different ways that economists think about cost, which can get pretty complicated. So to understand this video, you should have open my Excel file that's called Firm, Production, and Cost, and scroll over to the tab that says Short Run Cost Example. So what I've made for everyone at the top is a little table that will hopefully kind of make this stuff more manageable. Now we've already talked briefly about fixed versus variable. If you guys remember, fixed costs are your overhead costs, the costs that do not vary as the firm's production quantity changes. So an example of that would be, for example, the lease I have on a building. I have to pay that lease as a manager whether I produce nothing or whether I produce 1,000 units or 10,000 units, I'm paying that lease cost. So typically the costs associated with your physical capital, your buildings, your factory, maybe your computer system, your accounting software, stuff like that, that does not change as output changes is a fixed cost. Your variable costs do vary as output changes. So for example, for most firms in the world, the most important variable cost is their wages they have to pay. The higher your production level, the more workers you're going to hire, and therefore the higher your wage expense is going to be. If I produce a physical product, I probably have materials expenses. The more I produce, the higher the total materials expense would be. So that would be another example of variable. Now take a look at this first column here. If I'm just simply looking at the total amount that the firm is paying for these different types of costs, we're going to call that a total cost, or just simply TC for short. So TFC would stand for total fixed cost, and that would again be the sum of my leases, my building expense, my computer system, the software, anything that is fixed in amount. TVC would therefore be the total variable cost, and that would be the sum of all the components of my variable expenses. So my wages for my workers. Okay, so I would take my wage rate times the number of hours, and I would sum that up for all my worker types. I would add my materials, etc. And then my overall total cost, or just TC, would be then the sum of fixed plus variable. Now the next two columns are two additional ways to think about cost. Marginal, which we're going to call MC for marginal cost. Marginal in economics always means incremental. In other words, instead of looking at the total cost of all the units that my firm is producing, I break them down and I look at them in terms of batches. And I say, if I produce one more unit, or I produce the next batch of units, how much incrementally is that going to add to my cost? That's the essence of marginal thinking. Let's take a look at this row here. Why do I have a 0 there? Kind of a brain teaser. Well, I have a 0 there because fixed costs never change as output changes. So if they're constant, there's never going to be a change in my fixed cost as I produce more. So my marginal component of that is going to be 0. Let's think though about, for example, if I hire more workers. The additional wages that I'm paying them is going to add to both my variable cost and my total cost. So the way I would measure that is I would simply take the change, literally the difference, the subtraction. How much was I paying the workers before? How much am I paying the workers now that I've added more workers? Look at that change in the numerator and simply divide by the change in the associated change in quantity as I hire, let's say, more workers. I could also then look at the change in my total cost divided by the change in quantity. Okay, so marginal is always about changes. And in a subsequent video, we're going to look at a numerical example to make that a little bit more tangible. Now, the other way to think about costs are what we call average costs, or AC for short. Average costs are always cost per unit per means divide. So what you would do is you would take your type of cost, fixed, variable, or total, and simply divide by the total quantity that your firm is producing. The total number of production units goes in the denominator. Okay, so your average fixed cost is going to simply be your total fixed cost divided by the quantity that your firm is producing, so Q for quantity produced. AVC would then be average variable cost, and that would simply be total variable cost divided by the quantity that your firm is producing. Your average total cost would then be total cost per unit, or total cost divided by the quantity that your firm is producing. Let me show you guys a quick little example of why we care about this. Let's take a look at this example 1 here. We're going to imagine that you're managing a firm and your selling price to the consumer is $9.99 per unit. Suppose your marginal cost on that one additional unit you're thinking about producing and selling for $9.99 were $15. My profit on that unit would be negative because at the margin, incrementally, it's going to cost me more than I'm going to sell it for. What if instead my marginal costs were only $5? Now I'm making a profit on that unit. Okay, so as long as my price exceeds marginal cost, it's profitable to go ahead and sell the unit. So that's actually the most important application of marginal cost, is helping a firm decide, should I go ahead and produce the next unit? Now, average total cost tells me, am I profitable overall? Let's take a look at this example. Let's suppose this is the same firm, so I'm selling my unit for $9.99. Let's say that I'm currently producing 10 units of my product. And let's say hypothetically it costs $100 in total to make those 10 units. According to the definition, my average total cost is total cost divided by the number of units that I sell. Okay, so in this case, my average total cost is 10, and my profit overall, so my price is $9.99, but on average they cost me 10 times the 10 units that I'm selling is actually negative, right? So if this firm's total cost is over 100, let's say it's $150, the situation gets even worse. Okay, so under those circumstances, this firm should not be producing those 10 units most likely. Okay, let's say instead though your total costs were only $50. Notice how my average total cost is now lower, below my price, less than my price. So now I have positive profit. So simply comparing your price to your average total cost will help the firm determine, are you actually profitable overall or not? I know that was probably a little bit kind of conceptual, so in another video that I'm going to record, you're going to see an example of working with these cost concepts in a table.